important. Right, guys. So, guys, there are two standards that I want you guys to watch out from, all right, as you'll be doing your studies. There's IS 36, which is impairment of assets, all right? And there's IFRS 5. Of course, we haven't done it, all right? I think maybe it's coming for the next assessment. I'm not sure where it is located, but IFRS 5 and IS 36, these are very important standards. All right. Recall last year in the final exam, we did a lot of marks. So you really need to make sure that, especially X36, you need to make sure that you are comfortable with this standard. Otherwise, it can actually mess up your life. But don't underestimate it. It's a very important standard. It has a lot of principles, but it's not difficult, if I can put it that way. But you need to know your story very well. All right, so that's IS36 is about impairment of assets. All right, so IS36 now, guys, is about a loss in value of our assets. All right, for example, we can agree that you can be involved in an accident. All right, you just bought your G-Wagon, you're driving, right? You're just coming from the dealership. Then you have an accident. Now we can agree now, the moment you're involved in an accident, if you bought a G-Wagon for 2 million, all right? That means now you're involved in an accident. Maybe now the new value of your G-Wagon can drop to even like 1 million or even less than that, all right? So that's an indication of impairment. So literally when we talk about impairment, we are looking at loss in value of our assets. All right, there's so many ways that assets lose value. I'm sure you guys can agree with me. Right. Back in the days, I think around about 2010, right around that time, we used to have a Nokia phone. I believe you guys have used Nokia phones, right? We used to have Nokia phones, right? And then those Nokia phones, it was a big thing. Right? Nokia was actually a big thing by then. The continuous producing the Nokias, it had a long shelf life battery, right? It was good, it was a good swan, it was durable and all that, right? And then came Android. Samsung, or actually BlackBerry came in, all right, with BBM. I think that was around 2012, somewhere there. There was BBM, right? Everyone is running up and down with BBM, all right? And then now, there comes Android. Samsung and the other guys joined with Android. We're now using the touch screens and WhatsApp came in and all that kind of thing. So now what happened is Nokia became a thing of the past. All right. Now, what does it mean? It means now Nokia is actually impaired. All right. So I'm not sure about today, but I believe they still make phones, but they're no longer as popular as they used to be. They lost the market share value. All right. So what is that? That's also another thing, another indicator of impairment. All right. So in terms of this, when we talk about impairment, now we are saying no, impairment is not only about physical damage, but it can be through changes in technology. All right. I'm sure you have some softwares that you guys already know that actually have been replaced. All right, there was Mexit. I never really used it, but of course it was replaced. All right, and then a whole lot of online or social media platforms, they came in and left. All right, they've been replaced with better versions and all that. So those are also indicators of impairment or loss in value. All right, let's look at it. So IS-36, guys, is a standard that's governed by IS-36, of course, as the name says. All right. So the objective, right, around this, we're looking at it prescribes the procedures followed by an entity to ensure that assets are not carried at more than the recoverable amount. And the standard applies to the following. So in other words, we use IS-36 on property, plant, and equipment. All right. We recently did property, plant, and equipment. So IS-36 applies to those assets. It also applies on intangible assets, which is what we looked at last week. It also applies on investment property, recognized under the cost model. So what happens is under investment property, under the cost model, what happens with regards to this is if investment property is recognized under the cost model, we depreciate that investment property. Right, of course, it's something that we'll look at later on. All right, and then with financial assets, all right, under IFRS 10, all right, so IFRS 10, that's where Ms. Kiddis was saying, no, groups are actually not so friendly. So that's IFRS 10, we're looking at subsidiaries, all right, then IFRS 11, we're looking at joint arrangements, All right, we're looking about joint operations and joint ventures. Then IS 28, all right, it's about associates, subsidiaries, and all those kind of things. So literally, IS 36 is looking at impairment of those assets. Now, IS 36 does not apply to the following: inventories. Now, inventories, as you guys are aware, inventory is always measured at law of cost and net realizable value. There's no two ways about it. So IS2 on is on, all right? It does measure inventory, all right? They do measure inventory on their separate standard. So it's quite important, all right? Remember, we're going to be allocating impairment loss to the different assets. It's important that you know this list. All right, you need to know this list and this list. All right, so what it means is, as we go by with the studies, all right, we're going to calculate impairment loss of a cash generating unit. So what we do is impairment loss on cash generating unit, we need to allocate it to the different assets making up the CGU. So that impairment loss now we allocate it to plant, intangibles, investment property measured at cost, or the financial assets under IFRS 10, 11, and 28. So which means if the CGU is made up of inventory, deferred tax, and all that, that means we do not allocate impairment loss to those assets. All right. And then we have contracts, assets recognized in accordance with IFRS 15, revenue from contracts with customers, something we've covered. Deferred tax asset under IS 12. So saying no, IS 36 does not apply. So it literally means we do not impair these assets. All right, assets arising from employee benefits, IS 19. Then we have financial asset within the scope of IFRS 9, and then investment property that is measured at fair value. Then biological assets, of course, you guys don't do biological assets there. Then contracts within the scope of IFRS 17, that's insurance, we don't do that. Then non-current assets classified as held for sale, IFRS 5, that's a topic to be looked at later on. All right. Now let's look at impairment testing, all right, in terms of IS 36. So we do impairment testing on assets with indefinite useful life. Remember, I spoke about it when we did IS 38. Remember, we said, no, if an intangible asset has an indefinite useful life, it's supposed to be tested for impairment annually. Like, for example, goodwill. All right, goodwill has an indefinite useful life. So we test goodwill for impairment every year. All right. And then intangible assets not yet available for use, we test for impairment annually as well. For example, remember we spoke about development costs that are being capitalized. So now, if an intangible asset, internally generated intangible asset, is still going through development, so what we do with that intangible asset, we calculate, we test it for impairment, all right, for as long as it's before it is ready for use. All right. Then we have goodwill acquired in a business combination. All right. We did look at groups, all right, under IFRS 3. All right. We talk about acquisition of shares in a company where you're buying control. So they're saying, no, if there is goodwill that they acquired in a business combination, you should also test for impairment annually. All right. Then we have other assets. We need to test if internal or external indicators of impairment exist. All right, so in regards to this, we're saying no. In terms of this, we want to test if there's physical damage. All right, think about it. You buy a laptop today. All right, you bought a laptop today. Then your laptop, maybe your friend or your sibling or even yourself, all right, you step on the laptop by mistake. Then the screen cracks on the corner. Do you guys agree that's physical damage, right? That's also an indicator of impairment. All right. So indicators of impairment, sometimes in the exam, they do not state that an asset has been impaired, but they'll give you indicators of impairment. So you need to understand about the indicators of impairment. All right. So in regards to this, how do you know if an asset has been impaired? All right. So we look at it to see if an asset is impaired where the carrying amount is more than recoverable amount. All right, so we know that no, the asset has been impaired. Let's look at it in more detail. All right, what is happening there? All right, so recoverable amount. Now, what is recoverable amount? Now we can agree, guys, when you hold an asset, all right, there's two ways you can generate income from that asset. All right. So when you have an asset, it's either we sell the asset. All right. When you're holding an asset, is either we sell that asset and recover the value. All right. Economic benefits. All right. So in regards to this, so this method, all right, whereby we are selling an asset and recover the value, we call it fair value less selling cost. All right. Or we can recover the value of an asset through continuing using the asset. So continuing using the asset. All right. And make sell whatever produce and sell the produce. All right. So in regards to this, we call this method value in use. All right. Whereby, so under value in use, you're using the asset to generate revenue. For example, if it's a production, maybe you sell shoes. So you have a manufacturing plant that you use to manufacture shoes that you later sell. So value in use now is whereby you're continuously using the plant to manufacture the shoes that you later on sell. All right. And then fair value less cost to sell is whereby you decide to say, no, let me recover my money through selling this plant. So we call that fair value less cost to sell. All right. Now, guys, the recoverable amount is the higher of these two. All right. So literally what it means now is recoverable amount, we're saying what is the best use in regards to your asset. So it's either you sell the asset if it generates you more income, or either you continue using the asset if it generates you more products that you sell at a higher value. So that's literally what we have in regards to value in use. So the recoverable amount now. So now we are saying now impairment loss, all right, is when carrying amount of an asset. All right. Now the carrying amount is now more than, right? Is more than the recoverable amount. All right. So literally what it means now is we're saying you can't record an asset, all right, at a price that is higher than the best use that you have with regards to that asset. Remember, we're saying no carrying amount, you're looking at it to say you bought this asset at this value. All right. Then you reduce it with the depreciation. That's what give you carrying amount. All right. But now we are saying the carrying amount of the asset cannot be more than, it cannot be more than the best use of your asset. So in regards to this now, the moment the carrying amount becomes more than the higher recoverable amount and fair value less cost to sell, it means the difference now is what we're calling impairment loss. All right. So basically that's what we have in regards to this part of the question. All right. So in terms of impairment loss, right, we said no. With regards to impairment loss, we have value in use, right, of our asset. So value in use of our asset, guys, now, all right, we sometimes they want us to calculate the value in use. So value in use is actually cash flows that you're expecting to generate from sales, all right, of the produce that you made from that asset. Then you use a discounting factor, all right, to present value those cash flows. So sometimes they give you the value in use amount, sometimes they want you to calculate it. All right, so it all depends with the question, all right, what they want in regards to the information presented there. So value in use can be calculated. Sometimes they give it to you. All right, then in regards to this, all right, we then have what we call fair value less cost to sell. So fair value less cost to sell is made up of selling price, the selling price that you have of your asset minus selling cost. So if you have to incur marketing costs and all those kind of things, you deduct them. All right, so fair value less cost to sell. All right, so this one is equal to selling price of the asset less costs such as marketing cost. Marketing and advertising cost, all right, or agent fee, all right? All those kind of cost. All right, so in regards to this, if you have to incur some other cost in order to sell your asset, you deduct them. All right, then value in use. All right, you said no. In regards to value in use now, you take the cash flows that you're going to be making. For example, I gave you an example whereby a company is selling shoes. All right, so you take what are the cash flows. All right, in other words, the sales amounts. All right, so cash flows for value in use. You record your cash flows for year 1, year 2, year 3, year 4. So it's always a maximum of 5. All right, we're going to do that just now. So value in use, all right, you have cash inflows. All right, cash inflows from the sale of your shoes. All right, you record them there. All right, and then you have cash outflows. Cash outflows, all right, from also the sales, sort of from, yes, from the sales. All right, maybe it could be the production cost and all that before you started selling. So you deduct those costs, all right? So you deduct them there, all right? In regards to this, that's what we have, all right? And then it gives you net cash flows, right? Always remember depreciation is not a cash flow, right? It's non-cash. So you have net cash flows, all right? That's your net cash flows. All right, then you discount these cash flows. So I, because we're going to touch what type of I you're going to be using, but in simple terms, we just use the pre-tax rate. All right, but we're going to be looking at it just now, what type of interest rate you use there. All right, and then you compute your NPV. So NPV, this is what we have as value used. All right, so if it's not given in exam, you can calculate your value use in this regard. All right, so basically, that's how we go about it, all right, in regards to that calculation then. Now, let's look at measuring recoverable amount, all right, of our assets. So we said no, intangible assets with indefinite useful life, all right. So we said no, previous year's recoverable amount can be used, all right, if paragraph 24 criteria are met, all right. So here we're saying no, what is the recoverable amount of intangible asset with indefinite useful life? So in terms of this, we can use the paragraph 24 criteria. Let's see what's happening. All right, fair value less cost of sale. So cost of disposal, it includes incremental cost to bring assets into condition for its sale. So sometimes if it happens now that before you sell the asset, it needs to go through some renovations. All right, that means now these are selling costs. You deduct them from the selling price. All right, but of course, the selling cost that we deduct there, it excludes finance costs. So in other words, it excludes interest. Right? If you have to incur some form of interest, it's not included. And also it does not include taxation. You know, so when you're calculating your fair value less cost to disposal, you know, so if you have to pay some tax, remember when you sell an asset, you have taxes like capital gains tax that you have to pay. So you're saying no, those type of tax, we do not deduct them from the fair value of the asset. The same applies with finance cost. But if there's some form of interest that you have to pay, you do not include it there. All right, then fair value is determined according to IFRS 13 principle. All right, it's a topic that we're going to be looking at as well. IFRS 13, all right, whereby we'll be looking at how do you determine the fair value of an asset. All right, but for now, for this purpose, you'll be given the fair value there. All right. And then value in use. So in regards to value in use, we need to estimate future cash flows from continuing use of an asset and from ultimate disposal. So literally what we're saying under value in use now, we estimate the cash flows. All right. If we expect to use an asset for 3 years, you record the cash flows for 3 years. If you expect to use it for 4 years, you record cash flows for 4 years. If it's 5 years, you record your cash flows for 5 years. All right. Now, future cash flows should be estimated for the asset in its current condition. Now, this is important. All right, I want you guys to take note of this. So, future cash flows should be estimated for the asset in its current condition and should not include the following. So, the future cash flows that we have, they do not include future restructuring to which an enterprise is not yet committed. All right, so if you have plans all right? You have plans to restructure your business, and then you anticipate that you're going to be making money, let's say 1 million. Now, it means now because this 1 million is a future restructuring cost, it does not form part of the future cash flows we use to determine value in use. All right. And then future capital expenditure that will improve or enhance the asset's performance. We also do not consider that when you're calculating the cash flows. So we just consider the current capital expenditure. So in other words, if we incurred current capital expenditure with regards to improving, right, the performance of the asset, we include it in our cash flows. But otherwise, if we have anticipation that maybe we're going to restructure the asset and then it generates revenue, better revenue in the future. Now, it means those restructuring costs, we do not include them when we're determining our cash flows for value in use. All right. And then we apply appropriate discount rate. So it's always a pre-tax discount rate, right? But we're going to come back and explain further there. Right. Estimate of future cash flows based on most recent financial budget that is approved by management. And then you say tax and finance are not included in this regard. Right. Now let's look at it, right, in regards to this. So the following elements shall be reflected in the calculation of assets value in use. So I expect you guys to highlight paragraph 30, right? Highlight it well, right? You can just highlight the heading there. All right, so what is happening now? Sometimes they give you different cash flows. So you need to know what type of cash flows you include. So we're saying, no, the following elements shall be reflected in the calculation of assets value in use. So one, an estimate of the future cash flows the entity expects to derive from the asset. So we say, no, let's take into account an estimate of the future cash flows the entity expects to derive from the asset. Whereas in regards to this, reference is made to cash flows and not profits. Therefore, students, right, you guys should carefully assess if they are required to convert budgets or focus of profits into cash flows. This would typically require adjustment for non-cash items. All right. So now what happens now? All right, in regards to this, sometimes the examiners, they give you net profit. Give me net profit before tax. Now, if you're given net profit, all right, you need to understand now that net profit includes things like fair value gains. All right. So please just look at it. All right, calculation of cash flows. All right. So in regards to this, we are saying now, all right, if, all right, the starting point is net profit, say net profit before tax. All right. This principle applies on this module, all right, for value in use. It also applies to valuations, which I believe you'll be writing on assessment 4, where you do the free cash flow valuation. So if your starting point is net profit before tax, let's say they give you net profit before tax for year 1, 2, 3, and 4. All right. So here they give you net profit before tax, just as an example. All right, for year 1, 2, 3. All right, let's just end there. So what do you need to do? All right, you're given the net profit there. It means now you now need to reverse non-cash items, non-cash transactions. All right, so what do you need to do? You need to add depreciation, all right, on the assets. So you add it back because remember you want to determine your cash flows. All right, so you add depreciation, then deduct fair value gains. All right, maybe on investment property. All right, so your fair value gains on investment properties, you deduct them. All right, on the years that you had the fair value gains, so you deduct it in that year. All right, and then if there is also profit on self asset, all right, so you need to deduct, reverse it, deduct profit on self asset. All right, so if it happens maybe in year 2, they plan to sell an asset and make a profit, you deduct that. Then this is what then give you your net cash flows. All right, so net cash flows will be sitting like this. All right, so literally, this is a quite important principle as well. So the cash flows, it all depends with what information you're presented with. All right. So in regards to the cash flows, right, you also need to consider this. Expectations about possible variations in the amount or timing of those future cash flows. So in regards to this, we're saying, no, the cash flows, they should also, right, reflect a possible variation in the amount or timing of those future cash flows. Right. Also, the time value of money represented by the current market risk-free rate of interest. All right. I expect you guys to know this. All right. I remember in one of the paper they asked this. All right. So you say, no, the cash flows, they should also take into account the time value of money. Also consider risk-free rate of interest. The price for bearing the uncertainty inherent in the asset and other factors such as liquidity that market participant will reflect in pricing the future cash flows they need expect to derive from the asset. So literally now what happens if the examiners want to trick you guys, they can give you different type of cash flows. Say for example, they can give you cash flows where they say, no, the cash flows does not include liquidity and other market participants. What do? It means that cash flow, you do not need to include it in your value news calculation there. All right. And then the next step, all right, in regards to the estimation of value news, all right, so in regards to this, we're now in paragraph 31. So it's about estimated the future cash inflows and outflows to be derived from continuing use of the asset from its ultimate disposal, all right, as well as applying the appropriate discount rate for these future cash flows. All right. So basically, that's what we have in terms of this part of the question there. Right. Any questions so far, guys? I understand we haven't done like a proper question, but is there anyone who has a question for me so far? No question. Okay. Yeah, that's cool then. So if you guys don't have questions for me, makes me happy then. All right, let's proceed now, all right, to the next part so that we can see now what's going on there. All right. So in terms of this other part now, all right, I want to look at basis for estimates of future cash flows. All right, what basis now do we use to estimate these future cash flows? All right, that's what we want to look at now. All right, so in regards to this, all right, to estimate the future cash flows, so it is apparent that the normal principle of financial management are being used to determine the cash flows. However, I-36 states that the following should specifically be taken into account. Cash flow projection should be based on assumption by management, supported by external evidence. That's paragraph 33A. All right. And also cash flow projection should be based on the most recent financial budgets or focused management, but shall exclude any estimates of future cash inflow or outflows expected to arise from future restructuring. We spoke about this, right? And then projections based on this budget or focus are limited to 5 years. Sometimes they want you to discuss, all right? It's unfortunate now that if you guys take this theory lightly, all right, it might come to haunt you. So you need to make sure that you know what I'm talking about. So we limit the cash flows. All right, you see, in regards to this, we said, no, the cash flows for value news. If they give you cash flows to maybe year 10, you limit your cash flows to year 5. You need to know that. All right, this theory is very important, guys, please. All right, sometimes they can say identify errors, all right, on the calculation of the cash flow. So we need to make sure that we are comfortable in this regard. All right. Then cash flow projections beyond the budget period should be estimated by extrapolating the projection by using a steady or declining growth rate for subsequent years, unless an increasing rate can be justified. So in regards to this, that's paragraph 33C. So we look at it to say, no, sometimes it happens that our cash flows, right, where they give us, they could be maybe ending, the cash flows that they can give us, they could be ending, maybe the cash flows are ending at year 4, right? But then they said, we anticipate the cash flows to be growing at 50% per annum. So in that case, now we now need to estimate the continuity of value, all right? We're going to look at that in one of the examples, but it's a principle that's more into valuations for MAC, all right? And then estimates of future cash flows should include, as paragraph 39, projection of cash inflow from the continuing use of asset, projection of cash outflow are necessarily incurred to generate the cash inflow from the continuing use of the asset that can be directly attributable, allocated to a reasonable and consistent basis to the asset, and net cash flows, if any, to be received or paid for the disposal of asset at the end of its useful life. All right, so in regards to this, what I expect you guys, all right, I want you guys to be highlighting, all right, in regards to this, you highlight the heading, paragraph 39, all right, so they know, oh, the cash flows are supposed to be including these amounts. All right. Now let's look at foreign currency future cash flows, right? Of course, in regards to this, the level 1 guys, you don't need to worry about this, right? You don't do IS-21. Right, so in regards to this, of course, saying, no, we need to discount the foreign currency, then you spot rate on day of value use calculation. So if you're given the foreign currency transactions, right? So maybe you have your cash flows that are generated in foreign currency, translate them using the spot rate, right, on the different tests there. Then, so in regards to this, all right, we have now determined, or we have calculated our impairment loss. So what is the next thing since we've calculated impairment loss? So the next thing now, all right, that we now need to do, if we've calculated impairment loss, will be now to determine, all right, we're going to need now to determine if, all right, so if we've calculated the impairment loss, we now need to determine subsequently if there are reversals of impairment. Take, for example, especially in terms of technology. There's new technology in the block, all right? Now, if the technology, say, for example, all right, for example, makes it, all right? I just overheard that it's trying to come back again, all right? I'm not sure, I haven't really used it, but I'm hearing that it's trying to come back. So in regards to that, what's happening? Literally, it means now there's a reversal of impairment. It had lost market share, but it's starting to regain the market share. So in other words now, so you need to assess those factors that indicate that the asset that we're dealing with might have been impaired. Is the impairment still ongoing, right? Or has the impairment been reversed? So literally in regards to this, that's what we look at now in terms of reversal of impairment. But before we do that, all right, I'm just going to quickly, I forgot to share this question with you. All right, we can just quickly run through it together. Just going to quickly share it on the group, then we'll run through it together to see how we calculate the value in use before we look at the reversals of the impairment there. So in terms of this, remember we did spoke about the value in use and all that kind of thing, right? So let's see now, all right, what's happening, all right, in regards to this. So it says it says with reference to Fence Limited, Gauteng Manufacturing Branch, cash generating unit, calculate the following on 20th February 23. The impairment of the cash generating units, all right, the carrying amount of each individual item, assets, and liabilities contained within the cash generating units after the impairment. All right, so let's quickly see, all right, in regards to this now, what's going on, all right, about that plant there. So this is actually past exam paper. All right, so it says Fence manufactures steel fences. Fence is listed on the JSE and there's a 20th February financial year end. Fence has 2 manufacturing branches situated in Gauteng province and others situated in the Western Cape province. Each branch is cash generating unit as defined in terms of IS 36 of impairment assets. Okay, for now, don't worry about what is a CGU. All right, we're going to do it. The following information is contained within the company's accounting policy. Factory buildings, plant, and vehicles are accounted for according to the cost model in terms of IAS 16 property, plant, and equipment, and are depreciated over their respective useful life by using the straight line method after consideration of any residual value. Gauteng manufacturing branch. During February 23, the Gauteng manufacturing branch was severely affected by flooding that occurred throughout a major part of the country. The following information related to the Gauteng manufacturing branch was supplied to you. So this is what we have. So in terms of this, all right, now let's look at the information that we have. Do you see the branch was severely affected by flooding? This is an indicator of impairment. All right, there are floods that affected the branch. So we can agree the moment there are floods, that's an indicator of its physical damage, right? So that means now the building, actually we can agree now that there's physical damage to our property. That's an indicator of impairment. All right, now let's see, right, in regards to this, what's happening. The following information, let's say Gauteng manufacturing branch was supplied to you. Factory building, plant, vehicles, inventory, trade receivables, and bank and trade payables. Now, what is happening in regards to this? Remember our scope, all right? Earlier on, we spoke about the scope for IAS 36, where we said, in terms of the CGU, all right? So we have property, plant, intangible, and all that. Then we have these items. They do not form part of the allocation of impairment. So which means now you need to be careful in regards to this. You see, factory is part of the scope for IAS 32. It's PPE. Plant, part of the scope. Vehicles, part of the scope. Inventory, IAS 2, excluded from the scope. You see. And then, what else do you have? Trade receivables. This is financial instrument. All right. So financial instrument, we said it's under IFRS 9. It's excluded from the scope. All right. Then you have bank. That's also, remember, financial assets, it includes cash. So it's excluded. Trade payables, financial liability, excluded. So which means now if you're calculating impairment loss for the CGU, you only allocate it to these assets, but we're going to look at it next week. Now, you may assume that the above items are correctly identified as items that form part of the cash generating unit. You may also assume that items are correctly calculated and accounted for unless the information in the notes below indicate otherwise. Sorry, not next week, but Friday class, sorry. Plant was ready for its use as intended by management, 1st of March 2018, at a cost of 5,024,160. At initial recognition, the useful life of the plant was estimated as 8 years. All right. So basically, that's what we have in regards to the plant. I want us to look at this information. All right. Now, on 20th February 23, the fair value less cost to sell of disposal for the Gauteng manufacturing branch amounted to 5,580,000. What are you trying to calculate? Recoverable amount. All right. So remember, we said recoverable amount is higher of. All right. In regards to this, so recoverable amount equal to higher of. Higher of what? Fair value less cost to sell. All right. So in regards to this, you are given, all right, in terms of this question, they gave you the fair value less cost to sell is 5,850,000. So they gave it to you. All right. That's your recoverable. Sorry, that's your fair value. Then now, your value in use. All right. Let's quickly see how much is the value in use. So on 30 March 23, firms will pay 110,000 to repair the damage to the factory building and 175 to repair the damage to its plant. No vehicle were damaged. All right. So in regards to this, that's basically the information that we presented there. All right. Let's now proceed. The training accounted included the following items with the calculation of estimated future cash flows for the Gauteng manufacturing branch. So if cash inflows, see they're sitting there. Depreciation, all right? See the depreciation sitting there. Cash outflow from operating expenses, total before taxation, sitting there. Then taxation, sitting there. Now, in regards to this, you may assume that all values are mathematically correctly calculated. For calculation purposes, you may assume that all cash flows incur at the end of the financial year. All right? So, the above amounts are estimated in real terms. All right. So in terms of this, they're telling you now that the above amounts are estimated in real terms and have not been adjusted for any uncertainty, all right, that is inherent for the business. They've never been adjusted for uncertainty. Now, what is our standard say? Do you see? It becomes a bit tricky, all right, in regards to this question. Let's look at it and see it. Now, inherent to the business, all right, the inflation forecast for the period under review is 4.25%, all right, and certain inherent to the business risk was determined at 1.75. Tricky, right? Now, what did we say? What did we learn about that? Let's quickly go to our cash flows. I'm sure someone was like, these guys just reading these things out of nowhere. All right. So we said, all right, in regards to the cash flows, we said, no, the cash flows, all right, they should, let's look for that part where we talk about inherent risk.
It's just above, you just passed it, my good son.
Just past it. But let's see, is it up? Up again.
Yes, go up again.
All right, is it here?
No, go up. I saw you highlight there
Oh,
where it
yeah.
says risk-free. I
All
think
right,
that's
let's look at it. All right, thank you, sir. Right, so now, remember, if you look at paragraph 30, we said, no, cash flows, they should include an estimate of future cash flow the end expect to derive from the asset. Expectations about possible variation in the amount or timing of those cash flows. The time value of money represented by current market risk free of interest. The price for bearing the uncertainty inherent in the asset. There are other factors such as liquidity that market participant would reflect and bring the future cash flows they ended expect to derive. So literally, that's what we have, right, in regards to this part of the question. All right. So let's see. How best are we going to do the calculation? So we are given now, these are real cash flows. So real cash flows, guys, it means these cash flows do not include inflation. That's what real cash flows mean. So in other words, it means now they did not take into account a risk. All right? That's what it means in regards to that part of the question there. All right. Anyways, let's just now determine our cash flows. So the cash flows, right, in regards to the calculations, we have 24, 25, 26. All right, so in terms of this, so we can just record cash flows for 24, cash flows for 25, cash flows for 26. All right, so in terms of that, right, we have now, all right, we can recalculate. So there's two ways that one can go about it. All right, so you can start off with this profit before taxation. All right, you see this amount. You can start off with this amount, then you add back depreciation. All right, then you have your cash flows. Or somebody can say, no, I want to start off with my cash inflows and take the correct ones. All right, like what they did there. All right, they've started off with these cash flows. All right, and then after that, all right, you then have, of course, you account for other factors as well. All right, so the choice is yours in regards to this part of calculation there. All right, so let's see now, all right, what's happening. So we have cash inflows. Let's start from the top. All right, so we have cash inflows. So cash inflow. All right, so in terms of the cash inflow, all right, let's see if it was a question. The recording is stopped. Okay, so no, right. So cash flows, we have 2,900,000. We're recording, right?
Right. Yes.
Okay.
yes.
All right. So the cash flows, we have 2,900. Then 2025, we have 3,190. Right? And then we then have 3,509. All right? That's our cash flow. Then you proceed. After that, depreciation is non-cash. All right? No need for you to write non-cash. All right? There will be no mark. But I'm just going to guide you. But you don't need to write this in the exam. All right? Non-cash. All right? So in this case, it's 0. All right? And then you move on. All right? You have cash outflow from operating expenses. All right? So in regards to this, cash outflow, operating expenses. Right, you're going to need a financial calculator, right, in regards to this. So the cash outflows, so you're going to take your 480,000, right, you deduct it, all right, and then the next one is 528. 528, all right, then the other one, in regards to this, is sitting at 58800. Right, so we have our cash flows sitting there, all right, is it all right, in regards to this? Let's see what's going on if there's other things that we have there. So in terms of this, all right, if we look at the information that we are presented now, right, you see, so we've been told there's repairs, right, on 30 March 23, fence will pay 110,000. You know, they're going to pay 110,000 to repair the damages to the factory building, all right, and 175,000 to repair the damage to its plant. No vehicles were damaged. Right, so in terms of this, do you see, right, with regards to the information that were presented, all right, 30 March, what is our year end? All right, in terms of the information, of course, we just tagged it from the middle of the question, but you see the year end is 20th February, all right, so which means now, in regards to this, all right, in regards to the information that we are presented, all right, if we look at it, that means now we're going to incur some additional cost as well. So we have these costs, right, 110 and 175. So this is about repairs, all right, so we're going to incur repairs, all right. So in terms of the repairs, we have repairs of what? We have the repairs of the fence, all right, so 110,000. So we have repair of fence that's sitting at 110,000, right? This year. And then we also have another repair, right, which is about damages to the factory building. Oh, this one is for the plant, all right? So plant, repairs of the plant, right? We incurred this period as well, 175,000. Right, so basically that's what we have, right, in regards to our assets, right? And then, in terms of this, right, with regards to the assets that we have, all right, if we look at the information, of course, we didn't really read everything there, all right? We are told now, all right, in regards to the plant, all right? Now, the plant, all right, it is estimated, initial recognition, that it will cost the company 450,000 to decommission the plant at the end of its useful life. All right. So the plant that we have at the end of its useful life is going to go through decommissioning. All right. It's fine. You can sum it up. It's too fine. All right. Or you can split them. It's too fine. Doesn't matter. All right. So in regards to this, we are saying no. We have to incur future cost. All right, in regards to our plant. So which means now, in regards to this, do you see? Remember, we did under PPE. We did about decommissioning cost. So which means now the decommissioning cost we recorded, remember it's money leaving the business. So we have to pay 450,000. All right. So we have decommissioning. All right. Decommissioning cost. This is at the end of our project. All right. So in this regard, it's sitting at 450,000. So that's what we have now is forming part of the decommissioning cost. Everyone's still with me, guys. Then we calculate now the net cash flows. All right. So net cash flows, all right, is going to be, they're going to be sitting like this. All right. But now, remember now, the net cash flows in real terms. All right. These net cash flows, they're in real terms, not nominal terms. All right. So let's make a note. All right. The cash flows are in real terms, not in nominal terms. So what does it mean? All right, if we have the cash flows now that are sitting in real terms, not in nominal terms, let's look at the discounting factor, all right, which they probably gave under additional information. All right, you see under additional information, all right, look at it. The annual compound, do you see, they give us the nominal discount rate, right? To similar business is 9%. So here now, they give us the nominal discount rate. So which means now, our I is given in nominal terms. But now, do you see the cash flows are in real terms? So which means now, it does not make sense, all right? It does not make sense for us to discount the cash flows using a nominal interest rate, all right? What it means now is we need to adjust our nominal interest rate so that it becomes a real interest rate in order to match the cash flows that we have there. All right, so to do that, all right, to adjust in regards to this, we reduce with inflation. All right, so in terms of this, the discount rate now, so which means now the real interest rate. All right, we're going to take nominal rate. All right, it's nominal rate minus inflation. All right, so minus inflation rate. All right, and also, so in this regard, we minus the inflation rate, and then, but with regards to this, all right, we are also given uncertainty inherent risk, which is 1.75, which means now we add, all right, uncertainty risk. So we add uncertainty, all right, so that we come up with a real interest rate. All right, so it's a principle that, of course, we might not be familiar with, all right, as yet, but you guys can see it. So we minus 4.25, all right, and then we add, all right, in regards to this, the risk uncertainty is 1.75%. So in terms of this, that's what will then give us our discounting rate. So with 9% minus 4.5%, plus 1.75%. Right, give us 6.25. Then we calculate the NPV. All right. So can you guys quickly work out the NPV there? So in regards to this, we have cash flow 0. All right, on our financial calculator, cash flow 0 is 0. All right. Then cash flow 1 on our financial calculator is this amount. All right. And then cash flow 2 in this regard, this amount. All right. Then cash flow 3 is going to be this amount. And then I is 6.25. Right, then you guys compute NPV. How much are you guys getting? Quickly, let's quickly work it out, all right, to determine the NPV there. So first clear your calculators, of course, all right, in regards to this calculation. So you need to clear calculators.
And I'm getting 6,440,000. Yeah, 6,433,538.
All right, okay, cool. Let's just wait for confirmation from others. So Kiditsa is saying she's using Sharp. Is there anyone who is using Sharp then? How did you guys determine the components? Anyone wants to guide here? Who's using Sharp?
Yes, I do use Sharp.
Okay. Miss Lavisline, can you guide them?
She must first clear the calculator.
All right. How do you clear that?
Second function alpha, and then she can press 0 from there. It
All
will
right.
clear.
So you 0, 0, 0, right? All right.
Yeah.
Fantastic. Are you following, ma'am?
Yes, I am.
All right. Fantastic. All right. Then what do we do after that?
Since our cash flow 1 it's CF0 is 0, so she can just press 0 and then enter.
Okay. So
And then it will say data set CF0.
Okay, fantastic. So she says, no, you first press 0, right?
Yes, and then she says enter. It
Okay,
will say data set CF000.
all right. Are you
And,
following,
and
ma'am?
then she
Yes, I am.
All right,
and
go.
then you press you enter the second figure, which is 2135.
Mm-hmm.
And then she press enter until all the cash flows she's done.
Are you
She
following?
must enter all the cash flows and enter until when she's done.
Okay. Thank you.
And then after you are done, you
Mm.
press second function CFI,
Okay,
and then you
Okay.
enter your rate, which is 6.25, and
Mm.
then you enter, then you press the arrow that's pointing downwards,
okay,
and then it will show NPV, and then you press compute.
okay.
Okay. Thank you.
All
All
right, you're such
right.
a good teacher. Thank you. Right, so how much is the PV now? Are you guys tallying with the one that we have there, or is different? How much are you guys getting as NPV?
It's different from my side, but I want to try
Okay.
with
Oh,
plus or minus the
mm,
CFI and
okay.
see if maybe I'll get the same answer as he did.
Okay. All right. Anyone who got it, guys? Whether it's the same or different, how much do you guys got? So we have 6,403,000. I don't know if there's anyone who's getting a different amount or the same, just to confirm. Guys, we don't know how to do NPV, or you guys don't have calculators.
My
Ian,
calculator is strong.
I
Mhm.
got the same 6433 as Naeem is texting on the chat
Yeah.
that he
All right.
got that.
All right.
But I only got that using these cash flows when I have pressed plus or minus, not as positive as it is.
What do you mean by plus or minus?
On the sharp, you have an option of pressing plus or minus, so I have
So,
to,
so you entered your cash flows as negative.
yes.
No, but your cash flows are positive. Remember, it's net cash inflow. So you record them as negative if it was money leaving. But here you have positive amount, so you don't use plus or minus in that case.
So if it's positive, I got 27,655,849.
Really? Eh,
Yes.
why are you guys getting different amounts now? All right, let's see. So in this regard, looks like 643 is the one that's ruling. So you're just gonna keep that as our balance there. Right.
Yes, I also get 6433.
All right. Fantastic. Right. So if you didn't get this, please amend. All right. So that's our NPV. All right. That means this is the cash flow that we have there. All right. So that will be our value news. All right. Then next week, all right, in regards to this, sorry, on Friday, we're going to complete. No, I don't think we'll complete. All right. We're going to do it the other week because this is an important standard. All right. We're going to look at it again next week. All right. Then, of course, we'll be done with impairment loss. All right, we'll start looking at other questions and all that. But please, guys, don't underestimate this topic. All right, it's either it can give you a pass, all right, especially in the final exam, both levels. It's either it can give you a pass or it can give you a fail. I'm sure you guys can see, all right, with what we just did, the value news, there's lots of confusion, right, that could have happened in regards to this. So that's how this part, all right, that's how it can actually damage your studies. So please give it proper attention. It's a very important topic. It's way important than PPE, important than many other standards that you can think of. This standard. All right. Otherwise, have a wonderful evening. I'll see you guys on Friday, all right, where I'm sure we'll wrap off this part of the question. And then, of course, we'll look at another question next week. Right. Have a wonderful evening, guys. Bye.
Thank you, bye.
Good evening, bye.
Bye.
Cheers, yeah, bye.